What if the silver market isn't breaking, but quietly running out? Not crashing, not correcting, but draining ounce by ounce right in front of everyone. Most investors are still watching price charts instead of inventories, because behind the scenes, something far more serious is unfolding. Right now, the physical silver sitting inside COMEX vaults is dangerously low. Not low in a dramatic headline sense, but a structural system-level sense. The kind of low that doesn't matter until suddenly it does. According to official vault data, there are roughly 88 million ounces of registered silver left. That's the silver approved for delivery. But here's the problem. The futures market is stacked with contracts representing more than 240 million ounces of silver. Paper claims are now outnumbering real metal by almost 3 to 1. That gap isn't theoretical, it's physical. And this is where timing enters the picture. Analysts point to late February. If silver leaves vaults at the current pace, inventories could hit empty around February 27th. Not low, not tight. Empty enough that the system starts asking uncomfortable questions about delivery. Markets don't like questions like that. At the same time, silver's price behavior is flashing warning signals. A move toward $80 per ounce isn't driven by hype or momentum traders alone. This kind of move usually shows up when something inside the market's plumbing isn't flowing the way it should. When settlement, delivery, and supply begin to strain, prices react before headlines do. And notice what didn't happen. There was a popular narrative circulating that silver would drop due to reduced demand during China's Lunar New Year holidays. The logic sounded clean. Fewer factories, fewer buyers, lower prices. But silver ignored the script. Instead of falling, it pushed higher, climbing from the mid-70s straight toward $80. That tells us something important. Physical demand didn't disappear. It showed up quietly, aggressively, and without caring about social media predictions. Still, February isn't the final act. The real stress test arrives in April. March contracts may clear, but April is where the system has less room to maneuver. If fresh physical silver doesn't flow back into vaults by then, the consequences won't be limited to traders. Industries that rely on silver, solar panels, electric vehicles, medical equipment, defense manufacturing, all start feeling the pressure. That's when a financial issue becomes a supply chain issue. And this is where the hidden ledger slows things down and asks the question most channels avoid. Is this a genuine physical shortage finally surfacing, or a carefully managed pressure campaign designed to move price, sentiment, and positioning? History tells us markets rarely break loudly, they weaken quietly. Inventories thin, deadlines appear, narratives form. And by the time the average investor realizes what mattered, the window has already closed. So the real story isn't whether silver hits a certain price, it's whether the metal is actually there when someone finally asks for it. And that's the detail worth watching.